And the Federal Reserve starting their two-day FOMC, the rate-setting meeting. We'll find out tomorrow what they're going to say. But you will find out maybe today. We'll tell you what they're going to say here on the Markets Hub this morning. I am Paul Vigna. No, of course, we're not going to tell you what the Fed's going to say. We knew that. We'd all be hedge fund managers up in Greenwich and we'd be making millions and millions of dollars. But we can discuss the pressure that's on the Fed to act. The markets really seem to think something is going to happen. Mike Derby is with me to discuss this. Mike, how much pressure is really on the Fed at this meeting?
It does seem that over the last few weeks, the pressure has really built on the Fed to do something. A number of the Fed officials have spoken over the last few weeks have seemed to, they're acknowledging that the economy is doing worse. We've had a series of bad jobs reports. I mean, the data does seem to support, or has been given a lot of extra, it's put a lot of extra push behind the idea that some sort of easing, some sort of extra stimulus is likely to come. I guess what we're trying to sort out now is the timing of it. It could happen if the Fed's meeting tomorrow. They could, at the end of it, announce some sort of new policy, or there seems to be a greater expectation that there's a Fed meeting in September, in mid-September, and that meeting might be a better time for them to announce a new policy because they have new economic forecasts that they'll release at the time, and there'll be also, Bernanke will have a press conference afterwards. So if they're doing something new, it's a perfect chance for him to explain it. But even going into tomorrow, there is a lot of pressure for something to happen. It seems to me there's a lot of risk that the markets could be pretty disappointed tomorrow if they don't get something. I mean, a lot of the news reports have suggested something's coming. So I guess tomorrow is a bit of a challenging day for the Fed. I mean, it does seem logical to wait a little bit longer, but if they don't do something tomorrow, it could be another rough period for financial markets.
Okay, so we got a GDP report last week. It wasn't great. It showed growth, not great growth, but I mean, we know the jobs report coming on Friday is not going to be good. But are these things so bad? Do you think the Fed's looking at these things right now and saying, wow, things are so bad, we have to act? I mean, inflation doesn't seem to be a huge problem. You know, the stock market certainly is not a problem right now. You know, it seems to me that the Fed doesn't need to act right now.
I suppose at the point that we've gotten to with monetary policy, you can ask the question of, even if they do act, what are they even going to accomplish anyway? I mean, they even admit that anything that they do from here on out is not going to have the same sort of stimulative effect as the policies that they've done so far. So we're looking at marginal support. Bond market yields are already at rock bottom lows. How much farther can the Fed smash them down?
Not much.
It's a strange time for all of this.
You know, that raises an interesting question. How much ammunition does the Fed really have left? I mean, all they really control is the overnight interest rate, right? The short the Fed funds rate. How much ammunition? And they can do things at the margin. Well, how much ammo do they have left?
In a sense, they're hitting the whole yield curve now with things like Operation Twist and the various QE policies. So they can. Bank of America put out a report, I guess it was about a week ago, about nuclear options for the Fed. Like if everything,
sounds severe.
And actually, I mean, the threshold for nuclear options was new recession or deflation.
What's a nuclear option?
Targeting the 10-year, putting a ceiling on long-term yields, doing anything you can. I mean, just literally
unlimited buying
instead of saying
to meet a number.
Yeah, instead of saying we're going to buy $600 billion in long-term treasuries or something like that, you just say 10-year yields will not go above X, and you will buy anything that you need to do it. I mean, obviously,
but they're not at that point.
They're not at that point. They're not at that point. But the thing that was interesting about the report was the threshold that Bank of America saw to get to that really was not implausible. I mean, our new recession could happen, especially with all these fiscal cliff people.
Look, there are some people out there saying we're already in a recession.
Yeah, I mean, so recession's not is not an outside scenario. Deflation. I mean, if the price, I mean, we're near the Fed's target, but with commodity prices coming off the way that they are, and of course, food is going the other direction. But I mean, price pressures are low. They could go lower. So to me, it seems like some of these outside scenarios with what the Fed could have to do are not that outside. I mean, they're within the realm of thinking.
The nuclear option, I had not heard that one.